So let's look at another example of a trading security for a debt position. Lanzo Company buys and sells debt securities expecting to earn profits on short-term differences in price. That's the definition again of trading security. The company's fiscal year ends on December 31st. The following selected transactions related to Lanzo trading account occurred during December year 1 and the first week of year 2. So year 1, on December 12th, we purchased 50 Simpsons Corporation bonds at face for $175. So what does that face tell us? Well, in that case, if a bond is issued at face, that means the actual market rate and the stated rate are equal. It doesn't happen a lot, but in this case, that's what that tells us, that the stated and the market are equal. Therefore, the carry value of the bond will equal the face value of the bond for this. As far as the carry value on the books, we will not have a premium or a discount in that case. The 28th received interest of $1,000 on the bonds. The 31st, we record any necessary adjusting entry related to Simpson Corporation bonds. The market was $4,000. Again, the classification depends on whether we need that adjustment or not. And then January 5th, we sold the bond. So let's look at each of these entries really quick. It'll just take us a few minutes here. So December 12th, again, to record the purchase of a bond, it doesn't matter if it's HTM trading security or available for sale. We go in, we do it the same way. We're going to debit the investment in bonds. Now, we know the company here, so we can even go a little bit further and call it Simpson Bonds if we want to. You don't have to. You can just keep it simple and do investment in bonds. Just remember, sometimes that helps if you have 3 or 4 bond purchases. That way you can track them in your journals a little better when you're doing it on paper like this. And we're going to record it at the face value of $175,000. Then how did we pay for the bond? Well, naturally we're going to use cash. We never want to borrow money to do an investment. We always want to use excess cash that we actually have lying around. Okay. Then December 28th, again, this entry would not be impacted by anything else. There would be no premium or discount because they were issued at face. So the cash that we received, the $1,000, will actually equal the interest revenue. Even though we'd calculate them differently, the number would be the same because the effective and the market rate are the same. And the carry value as far as the bond itself and the face value are the same. Sorry, had a moment there. All right, so December 31st rolls around. Now, since this is a trading security, when we have trading securities, we do have to adjust those to fair value. So we're going to look at our bond. We're carrying it at $175 because that, again, is the face value and the carry value at this point. And when we look, the market price was $4,000 per bond. So now we need to see, well, wait a minute. If it's $4,000 per bond, how much does that come up to? So if you go in there and you look, so let's just go right here. There's $4,000 per bond. So if we take $4,000, I'm just going to add a little note here. We're going to multiply that by how many bonds did we buy? We bought 50. So what that's going to give us is a current market value of $200,000. Now, is that more or less than what we're carrying the bond at? Well, we're carrying the bond at $175. There is no discount or premium, so we're carrying it at $175 at this moment. So that means we have a $25,000 gain in the value of the bond. So we need to go in there and record a gain. Well, since the market value is greater, we need to bring our balance sheet up. So we're going to hit the fair value adjustment. We need to bring it from 175 to 200. So we need to bring that up by 25,000. And then we said we're going to have a gain, but this is going to be an unrealized because we did not sell it. So unrealized holding gain on our treasury stock. And again, we're going to denote that that is going to be recorded in income. So that's net income for 25,000. So that would be marking it at fair value. So the net of the fair value in the investment bonds would show us that we're reporting it at $200,000 on our balance sheet. All right. We're done with December 31st because that's our only bond. So now we need to go into January 5th. January 5th, we sold the bonds for $197. Now think about that. The first thing we got to realize is we're carrying these bonds at 200 on our balance sheet at this moment. The 175 and the 25 gives us 200 in fair value. So the first thing we need to do is adjust our bonds to that fair value of 197,500. Well, how do we do that? Well, we have them at 200, so we need to bring that fair value adjustment down just a bit from the 200 to the 197. So we're going to bring it down by 2,500. Again, how did we get that? Well, we're carrying the bonds at 200, right? They're currently worth 197,500. So that's a reduction in the value since we last recorded our entry of 2,500. Now, for this example, we're going to ignore the fact that there would be 5 days worth of interest accrue from the 28th, well, actually a few more, the 28th through the 5th. We would have a few days of interest there. We're going to ignore that for ease, but keep in mind we would have to take into account that interest payment as part. The problem doesn't have it built in. It doesn't tell us what it is per day, so I can't tell you that number. But in the real world, we would need to take into account that interest as well. All right, so this is actually going to be a slight loss this year on our position. So we're going to hit, instead of a trading unrealized holding gain, we're going to hit an unrealized holding loss. And again, this will show up in our net income. So we're going to hit that for 2,500. So the net of these two, okay, actually creates our total income on this position. We gained 25,000 last year. It was on our income statement. This year at sale date, we've actually lost 2,500. So we're going to show this year a loss. But the net of the 2 years will show the total revenue stream for this actual position. Then the last thing we need to do on January 5th is remove the position and show the sale. So we're going to hit the cash account for whatever the selling price of the bond was, 197.5. Now, we do need to take off all evidence of this bond. Remember, there's two accounts that we have to look for. One is the investment on bonds. Investment in bonds, not on bonds. And we're going to take that out at the actual face value. Now, in this case, and like the other two videos, we had no premium or discount. So if those two do not exist, we do not have to take that off. So we only have to remove the investment bonds on this issued at face, or purchased at face. So where's that difference fall? Well, notice we need a good 22,500 to balance. Well, where is that? Well, it's in our fair value adjustment. We put 25 in, we removed 22. So we're going to take away that fair value adjustment. So that's the second account we'll need to remove. Sorry, that's a credit. So let me move that over just a little bit for proper form. So that is sort of an example of how we would journalize that if it were issued at face. Again, trading securities, we must do the year-end adjustment. When we sell, we need to update the fair value to whatever the current fair value is at the sale date, and then record the sale of the bond. Now, last question. Indicate any amount that Lenso would report in its year one balance sheet and income statement as a result of this investment. So let's start with the balance sheet. Now really, we already said what we would record it at. We need to carry the trading security at fair value, which at the end of the year was 200,000. The 4,000 per bond times the 50 bonds that we actually hold, because we have to carry that at fair value. Now, the other thing it asks for is what would we show on our income statement? Now, there's a couple of things we would have on our income statement at the end of year one. Now, remember, at the end of year one, we have not yet sold these. So this is as of December 31st here. What would we show? Well, one, we would have had interest revenue for the year on this bond of $1,000. So that's one thing we would have shown. The second thing, notice we have that holding gain. So we would actually show a holding gain, and that would be equal to 25,000. So really, as a result of this position, we'd have 26,000 in income or revenues added to our income statement in this example.